discussion on monetary policy. And I would like to thank EGROW Foundation also to give me this opportunity of delivering welcome address and opening remarks. As we know, RBI is going to RBI monetary policy meeting is going to schedule on from 3rd August to 5th August. And we are discussing what kind of monetary policy would be there, whether any repo rate will be increased or not. As we know that Federal Reserve has increased 75 basis points in their monetary policy since their economy has contracted uh, 0.96% second quarter and more than 1% in first quarter. And their inflation rate is over 9.1% in June. So they were forced to increase repo rate to control the inflation. But in India, our last 6 months, our inflation is above 6%, and in June it is 7.01%. So that is above the comfort level. But other factors are not that bad. Like our GST collection is good. It is more than 1,48,000 in June, 1,48,000 crore in June quarter, in June month, and 1,44,000 approximate in May 2022. So our GST collection is good. Our auto sales are quite promising, and other factors like share market. If you say Sensex is around 58,000, is much better, and whereas FPI were selling their stock up till June. In July, they have reduced their selling, and I think it in some days it is positive also. So net effect, I don't. I think their selling is no more, and if it is there, it's very less. So that is also good for the share market, and so. Uh, Considering all these, we are expecting that there can be a monetary policy repo rate increase of 35 basis point. And since other factors are not that negative, even in Europe, they have increased 50 paisa basis point. Uh, they have increased their repo rate by 50 basis point. They have increased after a long gap. They have not increased so far. So, uh, so the conditions of this economy is not bad in India. So I don't think uh, accommodative stance they should change from accommodative to neutral. So they can still maintain accommodative because in forthcoming quarter, as RBI governor said that uh, inflation peak is almost there. It's not said that it won't be, inflation will not beyond 7%, but he has given a relief that this seems to be the peak. So considering all these, uh, I think from 25 paisa to 30, 50 paisa, it can be increased. So thank you very much. And all uh, I all Dr. Arvind Varmani, former Chief Economic Advisor, Government of India, has given the time to deliver his remarks. So we are very thankful to him. We welcome him. We also welcome other panelists, Ms. Upasana Bhardwaj, Sri Indranal Silgem Gupta, Abhik Barua, Sri Siddharth Sanyal, Dr. Charan Singh, and Sri Sabya Sachi Goswami. So, and other attendees who are attending this seminar. So, all are welcome, and thanks to everyone who has listened to me patiently. Once again, you were all welcome, and I conclude my remarks here. Thank you very much.
So you're on mute.
Thank you, Mr. Agarwal. Given that we have a tight schedule, I'll also try to be brief in my remarks. So this time I am not going to get into detailed kind of review of the numbers, which I'm sure my other panelist colleagues will do. And I want to take a slightly broader approach. Which is to give what my thinking is on the monetary policy approach for the next 6 to 9 months, given the global shocks and the very high uncertainty. I'm sure all the details and stuff the others will fill in. So as part of this, I want to do a quick review of the past 2 years, because I think they are relevant for looking into the future. In fact, in a way, I'm going to repeat what I said at the governor's meeting last week. So very quickly, from late 2020, and our SMPC minutes will show, I have been advocating, post-COVID, starting a bit before that, from in 2020, late 2020, post-COVID, we have been discussing this whole issue of supply chain disruptions. And one of the points we made over that time was that in India, these disruptions seem to be low, in the US very high, and most of the rest of the world intermediate. But that was the backdrop to, so the issue was we had this second wave, other countries were going through all kinds of other things in 2021. And since late November 21, I started saying, and that's where the Shadow Monetary Policy Committee comes in, that the RBI should change over to a neutral stance, or give a signal of moving to a neutral stance, though I did not then or in the subsequent two meetings define what exactly I meant by a neutral stance. But I was sensing that these repeated supply shocks may have somewhat longer effects, though it was still very unclear. So I was very tentative, but I think that tentativeness was taken as as kind of not very meaningful and not very useful. But I think in hindsight, it's clear that these small signals were appearing, that even if we were right, that each supply shock would have, it's a standard thing. When you have a supply shock, you get, or a shock, you get a bump up and then decline. But if you keep having these, repeatedly, you can't see the difference. Where is it ending and where is the new one beginning, and what long-term effects it may be having. In any case, so that was one. The second part of the reason why I was sensing this problem is because the US fiscal stimulus was clearly beginning to have a demand side effect. The point being that even if they are supply constrained in certain sectors, and in the US context, there was pumping in of the fiscal stimulus beyond the point where they were just trying to put a safety net against all those who were suffering. It seemed that at some point they started going beyond it to other purposes and other long-term things, and excessive amount of fiscal stimulus into the economy. And these were kind of the two reasons why I sensed that it was time to change the perspective a little bit. Anyway, so and at that same time, I did assert that the GDP growth rate of 7.5% plus minus 0.5 was likely to be the outcome. And I recall saying in one of the economists meeting with the governor that if the RBI's forecast agreed with this forecast of mine, then they should change to a neutral stance. But whether they agreed with this projection or not, they did not do so. And then we had what Mr. Agarwal and everybody else noticed, this sudden shift in thing. But my point here is not criticism. It is really to learn the lessons that when you have huge uncertainty, one has to be open to a lot more of intuition and looking at new signals. That's my basic point there. It's not that I was 100% certain. I was not. But I was beginning to become uncomfortable with my earlier stance because of all these things happening. And in a period of high uncertainty, you've got to go a little bit more with your guts than you would normally when you're just chugging along with your usual models. Now, one of the things which we also said was that the growth recovery would be led by demand for contact services, and which in Q1, and we already seeing the surge in contact services. So the implication for RBI is to make sure that supply constraints don't upset this recovery in services. Again, a point I made to them recently. But one of the implications to me is that if this recovery in services proceeds in India, then some of the pressure of the will be taken off the goods. Even before we come to the international, which I'm sure many of you are going to talk about the international demand for goods. But I think there is this element which a year or year and a half ago we had talked about in the US context, which actually didn't play out very well there. But I believe it will have some effect on our goods demand as these contact services continue to boom, obviously assuming no new COVID type of shock. And of course, finally, of course, the Ukraine issue and the oil shock uncertainty adding to these earlier uncertainties, and these I expect to continue for a year. So this uncertainty is not going to go away. One of the things which I had argued 2 months ago was that most people were talking about 100 plus minus 10 oil price. I insisted on a bigger band of 20, and of course we've had oil prices in the past 2 months go above 120. If I recall, they went up to 121 or 122 for Brent crude. So this uncertainty, and as part of that, I expanded my uncertainty range on the GDP forecast to plus minus 1 from 0.5%. So one of the implication of this is the projected recovery. As part of the recovery, I had said in Q2, Q3, we expect a housing demand and housing real estate to pick up, and in the second half, the private investment. This may be delayed. I'm sure all of you will have more detailed information on what effect this is having on the private investment. We look forward to that, but this clearly is a possibility which arose when we had this oil shock coming from Ukraine, and one of the things would be how much delays is there going to be in this private sector. I'm sure you have information you will give us, but there's something to be watched. So what are the implications for monetary policy? One is that I personally, again, others may disagree, please feel free to disagree. I don't think monetary policy, at least in the Indian context, is going to have. I think a lot in the others, but I'm not an expert on all the other economies. But I don't think monetary policy is going to have, any significant direct effect on inflation through demand or elsewhere. It may shift demand between sensitive sectors and others. I don't think it's going to have a big effect. So really, what the monetary policy has to focus on is how it can affect expectations. Clearly, one of the reasons for what I mentioned, my uneasiness late last year, was that perhaps it was beginning to feed into expectations, and hearing from all of you also, kind of indicating something like that. So what is the policy going forward? I think there are two elements which the RBI has to focus on. One is the real interest differential with the US, and second is the neutral policy rate. And I've been saying that the neutral rate is between, I would aim for, let's say 6 months ahead would be between 0 and 1%. And it turns out that recently, about a month ago, RBI has actually done a study, which they told us about last Monday. I had not read that study earlier, but their study shows two very interesting things. One is that they are getting a neutral rate of between 0.9 and 1 point something, with a big range of uncertainty around that. So two, this has been declining not just in India but all over the world. So these things fit with my recommendations of 0 to 1. I feel more confident actually for the 0 part of it rather than 1%, even though their numbers show 0.98 with a big range of, I think it was plus minus 1% or thereabouts. So I actually feel more confident that I really think we should go for a close to a 0, that range is still there. And secondly, the manner of getting there. The US, I believe, because they have this extra fiscal problem, which I mentioned, they have adopted some kind of an inverted V, or it's going to turn out like that, in my view. Again, this is arguable, and you may want to argue about it, but they had to raise their policy rate very sharply. But I do believe the things which are happening in the world and the US economy is eventually going to make it into a V, that they will actually have to reverse course at some point in the future. So from the Indian perspective for RBI, I believe a better method and more suitable to our conditions is kind of moving gradually towards whatever they decide. I mean, I said 0% rate, or if they decide 1%, whatever the RBI decides, to move gradually, more gradually than have this, kind of swinging real repo rate, which generally in our conditions creates a lot of unease in the market. So with that, let me stop. So that's my overview. I hope, I'm sure other panelists will get into more details of the entire inflation and GDP effects and so on. So with that, Upasana, Chief Bhardwaj, let me turn it over to you.
Thank you, Dr. Virmani. Yeah, so I think I'll just like to highlight a couple of points here. One is, of course, inflation. So globally, the challenge remains. We may be close to the peak of global inflation, but nonetheless, very elevated. So the downward trend is going to be very slow. And I think that is something which world as a whole will have to live with higher elevated inflation for considerable period of time, higher than respective economies' comfort level. Let's put it like that. And so will be the case for India as well. So one is to keep in mind whether that 4% medium target for India's MPC, that target can be achieved on a sustainable basis in somewhere in the near term, looks quite difficult at the moment because the baggage that we're still carrying from the pandemic, which has been further reinforced by the Russia-Ukraine problem, is still not out of the way. So while things seem to be easing, but it will be a very slow process of easing. And hence, I say that higher inflation for long. Having said that, I think the way I look at the inflation trajectory in terms of comparison with RBI's numbers, I do see softness versus RBI's own projected numbers. I think RBI had fair amount of cushion themselves when they last came out with their estimates. So H1 inflation reading, which they had given on an average around 7.4, 7.5%. We then had also highlighted that these numbers are a little on the higher side. And I think for the Q2 numbers, they would have to, my estimates are at least 30, 40 basis lower than RBI's numbers. So H1 will effectively be lower by about 20 to 30 basis in general. And third quarter seems okay with RBI, but again, the fourth quarter is where I believe that we could be seeing slightly lower estimates of than RBI's 5.8%. Having said that, inflation still remains high, and maybe briefly we do see levels going down and averaging around H1 of next year, slightly lower, but in general the trend is higher. So the need for action is still there. However much it is argued that India's situation vis-a-vis the rest of the world is not as bad for inflation. We tend to hear these arguments, but I think it's not entirely right. And those thresholds is something which we'll have to weigh against. So inflation is likely to remain a challenge, and hence RBI needs to act. Now the question is how bad?
हाँ कर लिया आपने किया ना
Okay, I think someone's Someone's not on mute. Request everyone else to be on
Mute
mute.
yourself and everybody who's on the show.
Personal only and working on it. Please go ahead.
Right. So from an inflation point of view, because MPC's mandate is clearly managing inflationary expectations and getting it as close as possible to 4, there will be a need to act. The only point is, I think if I look at the entire gamut of information with respect to growth and inflation and how it would be panning out, we are looking at not a very aggressive rate hike cycle as a whole. So I think there's need to front load the actions. So the way it is, we are looking at 50 basis of a rate hike in the upcoming policy. And overall, by the end of this year, we're looking at 5.75%. So cumulatively, 85 basis of rate hike. Talking about the stance, I think it's very important to keep in mind, Dr. Virmani did refer to the natural rate of interest that was referred to in the RBI bulletin. So 0.8 to 1% is that range which was mentioned. And I think we have heard this enough by the policymakers in the last 2-3 months that till the real policy rate is not achieved in the positive territory, the stance does not change to neutral. So one, honestly, I don't think there is too much merit to debate about the stance at this point in time. So I really don't consider that as a discussion point. I think more important is the fact how the MPC's mandate, the framework that they have a mandate that the operating target rate has to be repo rate. It is not about just the repo rate hike that we talk about, but the operating target rate, which very briefly in the last few days, we did see the entire overnight market curve shift higher, in fact, to the upper end of the curve, LAF corridor. But this was very brief. And again, today, what we see is that the rates are back towards the SDF, towards the lower end of the corridor. I think on a consistent basis, till we don't achieve that, I would say that the neutral stance or a slight restrictive policy stance is not going to be achieved. So somewhere that liquidity and monetary policy stance needs to be converging. And for that, the WACR, the weighted average call rates, have to be on a consistent basis closer to repo, plus minus 5-10 basis here and there, rather than more closer to SDF. I think that is one important aspect. Just on the liquidity side, I like to just mention one or two things here. Last few days, we have seen significant tightness in the systemic liquidity. And one of the important factors which have driven that is RBI's FX behavior. So despite typically, month end, we tend to see improvement in liquidity situation, but because there was almost net short position of RBI, so they were selling dollars to the tune of $10-11 billion towards the end of the month, that got totally offset by the government spending that probably would have happened. And just before that, also government has not been spending adequately, because of which cash balances are huge. And hence, we've been seeing liquidity tightness quite a bit. But that was very brief. And today we are again back to where we started with a couple of days back. So I think I'm just trying to highlight the fact that the MPC's mandate is to get the overnight rates moving towards repo rate. And that is more important to focus on in terms of stance when we say, wherein they will actually have achieved a policy normalization to that extent. So that is where I'd conclude with, I guess.
Thank you. Our next panelist is Shri Indranil Sengupta, Head of Research, CLSA India. Indranil? Sharan, is Indranil here?
Yes, Indranil is there. I saw him a minute back. Maybe he's just off, but we can go to Abhik and Sanyal. In the meantime, I'll call him up.
Okay. Abhik Barua, Chief Economist and Executive VP HDFC. All yours.
Yeah, I'm just going to very quickly comment on a few things that, Upasana has covered almost all bases. And I think it is interesting that she brought up the issue of the stance as it was perceived in the past, becoming a bit of a non-issue because the stance is now effectively being defined in terms of liquidity. and liquidity and the price of liquidity vis-a-vis some of the key levels in the corridor. So if you are bringing the overnight weighted average call rate on a sustained basis towards the repo rate or higher, then it's kind of restrictive and so forth. So I think discussing the stance as we did in the past in terms of neutral, accommodative, restrictive, I think has lost some of its meaning. Having said that, I think there is a problem of liquidity in the banking system. Liquidity has dropped quite sharply. And there is obviously a large asymmetry in banks. Some banks are not active lenders in the credit market, but for those who are, and if you just look at some of the June quarter numbers, I mean, these banks are operating at over 80% credit deposit ratio. And that obviously has an implication for liquidity. So I think some guidance on what the RBI would be comfortable with in terms of the liquidity balance, because that would, determine pricing and would give banks some degree of comfort, going forward, is very important. And there is a very large wedge between credit growth and deposit growth, with deposit growth falling behind, and that is leading to funding and liquidity problems for banks. So I think what I would look to the policy for, and since liquidity has become such a critical element of the mix, I think I would look for some guidance on where the RBI is comfortable. I mean, there are other, pressures on the RBI of managing the government bond program and so forth. So, given this, combination of things, what kind of liquidity level is it targeting? And again, I mean, one thing that where I would kind of differ with Upasana is that, and this sort of resonates with the first part of what she said and what Dr. Virmani said, that we are in an elevated global inflation situation, and this is likely to continue for a while. And some of it is because of structural reasons. I think in our meeting with the RBI governor, Dr. Virmani pointed to the various, structural shortages that emerged in the energy market, for instance, the doing away with nuclear power, for instance, then this, obsession with alternatives, low oil prices, which led to low demand, low investments in oil capacity, etc. So at least on the energy side, things will continue to remain elevated. Natural gas poses an immediate challenge because of Russia's strategy and Europe's stand on using Russian gas. And as Upasana pointed out, this is going to continue for a while. So should we? So in my mind, this doesn't quite. It's somewhat dissonant with the statement, if I heard it correctly, maybe I misheard it, that we should get to the 4% level as quickly as possible. Maybe we should do it over in a calibrated fashion over the long term, and not and maybe look at directional movement of inflation rather than get obsessive about the 4% long-term target. Perhaps we need to think of revising it going forward, given the vast changes that we are seeing in the supply situation. It could be it could be a temporary revision for 3 years, or we could target average inflation or what have you. But I think we need to reconcile to the prospect of inflation remaining elevated for reasons that are somewhat beyond our control. And I mean, we've seen very bad situations where monetary policy has kind of chased this inflation target and knocked the wind out of the growth sails. And when we're coming out of a pandemic, when there's been so much damage to the economy, I just hope that doesn't happen. It seems unlikely in this dispensation, but that is something that I remember very well in the past dispensation. I you know, just broadly, there are two things that I'd like, you know, on the interest rate side, there are two things that interest rates can do. One is, of course, manage inflation expectations, as Dr. Virmani pointed out. The other, which is again out of a textbook, is try to defend the currency by kind of outpacing the Fed or any other currency against which we are depreciating. But you know, given the fact that dollar strength is being driven by factors which go beyond just interest rate differentials, perhaps using interest rates as a currency defense mechanism will not help. New Zealand tried this recently, and it didn't have any impact on the currency, which kept depreciating. So, for instance, if you have a huge risk aversion in the system, which leads to a flight of safety to the into the dollar, then just fiddling around with interest rates and trying to at least keep pace with the Fed doesn't help. So I would sort of go back to what Upasana suggested: have front-loaded increases in rates. I would concur with her that we need to do a 50 at this stage, and perhaps stop at around 575 or 6 in real interest rate terms. If we have at least over the foreseeable future a level of around 5%, netting out base effects and so forth, then it sort of leaves you with roughly a real interest rate of around 0.75%, which is perhaps on the upper end of the RBI's band, or the band that Dr. Virmani was talking about. But that's where I would think the terminal rate should settle. And as I said, I'm just echoing Upasana here, that the idea of stance has kind of morphed into something that is somewhat unfamiliar. It is very different from the earlier notion of stance. So perhaps we shouldn't, discuss too much about it, except for looking at the liquidity implications of the stance in terms of which it is now being defined. Thank you.
Thank you. I just actually want to clarify or raise two issues which need to. One, of course, is this whole energy business. I often like to remind people that, if you had a oil shock, if you were running at 70 and you go to 100, the inflation on a year-on-year basis will last for a year. Nothing else happens, right? You go from 70 to 100, that inflation in oil will continue if you do it Y on Y. It becomes zero immediately if you go month by month or quarter. This is a very important point to keep in mind. So the theory, monetary theory, actually focuses on, they don't call this inflation. The inflation is over, because from month to month is zero. Very important to keep in mind. So if oil prices remain at 100 plus minus 0.5 and there's no further upward shock, that is not a concern from inflation perspective. Okay, it's the second order effects, the expectations which it affects, which is maybe a concern. Okay, so this point is often forgotten in the discussions, and it's kind of been my focus since I was well before I was CA. For those who don't, it's a bit complicated, but please go and think about it. Okay, so you cannot use that directly, the direct implication. The problem actually translates in because the income is sucked out. Even in US, which is a net oil exporter now, you are sucking out the consumption, the income of the consumers. That is the problem, one. Two is the inflationary expectations. But people, the central bank has to remind them that if it doesn't go above 100, actually if it reduces to 99, you're going to get a deflation. Okay, let me leave it at that. It's a little complicated to grab your mind around it, but in terms of the monetary actions in the conventional monetarist framework, it should have zero effect after that, except on expectations. Okay, if you're worried about the inflation expectation, yes, then you have to do something about it. Otherwise, no. Okay, that's first point. The second point is one has to be a little careful. I take your point, both your points. But MPC really, if we are talking about, they have to focus on the repo road. They don't have the liquidity instrument, by the way. That's the RBI. The MPC cannot expound on liquidity. They can have general views, they can have a discussion, they can support RBI, but they don't determine liquidity. Okay, as far as I recall the MPC mandate. So really, and definitely both your recommendations very useful. I think both of you are saying 50% in the next meeting and maybe up to 80 to 100 or whatever cumulative. So that's definitely relevant for the MPC. That doesn't mean we shouldn't discuss liquidity. We should, because we are not strictly here talking about the MPC. So the issue is, and it's very important. I think the points both of you have raised are very important, and if others have something to say about, how sustained inflation will be, but be careful about telling us whether it's on a year-on-year basis or quarter-to-quarter, because that makes a huge difference. Okay, makes a big difference to the way the policy will be determined. With that, let me turn to our next panelist. Siddharth, I think Siddharth is next. Unless Indranil is back, is he?
Yeah, I am on.
Okay, so why don't you go first? You were listed earlier. Yeah.
Okay, so we are looking at a 50 basis point hike in this policy as our base case. So two reasons why. Number one, inflation obviously remains high. We are looking at inflation averaging 6.9% for the year. And given the uneven rains, there could be some upside risk. Secondly, the Fed is obviously hiking. We expect another 100 basis points of rate hikes by the Fed. So if you look at past experience, you need to probably have a differential of around 200 basis points. And means that the RBI too will have to hike rates. Now, obviously, higher interest rates will impact growth. Our base case has been that growth comes in at 6.7% this year and 5.5% next year. But an US recession can reduce India's GDP growth by, I think, another 100 basis points. So, next year can also be a four handle. But I think that when the Fed hikes and when it is hiking against the kind of inflation that we are seeing, growth will get affected all over the world. And no individual central bank will have much ability to, fight that. So right now, obviously, there's a relief rally going on. I am not clear on what, but I think that when I look at the macro numbers in the West, there is a fair chance that we get into, a recession with high inflation. And that means that the Fed will have to keep hiking, and that's not good news for markets. If you look at the bear markets of 2000 or 2008 or even 2020, the Fed would begin to cut, by say 15% market fall. And in 2000 and 2008, the bear market lasted about a year and a half. So this time we are looking at the Fed hiking instead of cutting. So that I think also carries bad news for markets as well as growth. So net, I think that inflation is a problem all over the world right now, and you have to hike rates and tighten liquidity to bring it down. And to that extent, like I'm saying, that I expect the RBI to hike another 50 basis points now and another 65 basis points. So to go to a terminal rate of 6%. Because if we keep on running negative real rates like this for a long time, then we'll get back to, a high fiscal deficit, then we'll get back to the problem of the 80s and 90s. So I'll stop there.
Okay, that's a very pessimistic. By the way, I should modify my earlier comment. There is of course, when oil prices go up, it works through the system. The cost push, say on transport, fertilizer, etc. I'm assuming all that has run through at least the first shock, not the several rounds. But obviously that has to go through. It doesn't happen instantaneously. But I assume within a month or so, that has most parts of the world has gone through. So that definitely, of course, is there. But I'm taking that as part of the oil price. Now, Indranil here is very pessimistic. I see a somewhat different view here than from the other two. Let me clarify a little bit. You are saying the real interest differential, the risk premium with the US, India-US is about 2% points. Is that what you're saying?
See, it was 2% point, I think, when the Fed went to 6% in 2006. It used to be 2%. Otherwise, it's typically been much higher. I think the average, given that the Fed was at zero for a long time, the average is 500 basis points. Right now, it's like 250 and 490. So it's 240 basis points. Given that, you are seeing a high current account deficit, given that you are
talking about the real interest differential or just the risk premium?
No, the risk premium
should be zero. Normal assumption would be zero plus the risk premium, no? Or I'm not getting your reasoning here.
No, I think people basically trade the risk premium. The real rate here over time, but on a month-to-month basis, I think people trade the risk premium, nominal risk premium.
Right. So the differential you are saying is
between the repo rate and the federal funds rate.
Right. So that presumably your implication is that RBI should close that, right?
No, not close it. Keep it at least say current levels. I don't think. Obviously, we'll always be higher than the US. So at least maintain it at current levels. So if the US keeps hiking, the RBI will also have to hike the way, if you go back to 2005, 2006, it was a similar story, right? The Fed was supposed to stop at 3, instead it went to 5, and every central bank used to keep hiking. In fact, just the evening before and say that we are hiking for inflation or whatever. But there were days I remember when 4 or 5 central banks would hike in the same evening, including the RBI.
And you expect the same pattern. That is the point you're making, right?
Yes. I don't think the world has much of a choice.
Okay. Yeah, I just want to be clear for our listeners. I just want to just clarifying. I'm not arguing. It's just to be sure what you're saying. Okay, so that is one point. The second point, which is slightly unclear to me, is that if there's a deflation or a decline in China and there is a decline in US, what is fueling demand in the world that you think inflation will remain high? What is the driver then for your conclusion of stagflation? That part is not very clear to me.
So I think that, so I did a report as well saying that, if you looked at the US, 1980s onwards, money supply was not an issue. And so, there were supply shocks up and down, and that pushed up inflation up and down. But versus, and even during the financial crisis, although the US did put in a lot of money, there was no change really to M2 growth. But this time round, M2 growth has shot up to 20% odd. And I think a lot of the inflation we are seeing is a function of that. So in a way, I'm saying that, inflation has two parts. One is obviously, too much money chasing too few goods. The other is commodity prices. Now, commodity prices are also still high. Oil is still 100 plus. So, so from that perspective, other commodity prices also are high. They've come down from where they were, but they are still high. And if you now let go the brake, then they'll go up again. So from that perspective, I think that we have seen that if you looked at the past history of U.S. Inflation fights, the Fed has never been able to bring down inflation without a recession. And now, for all practical purposes, we have entered recession again. I mean,
Okay.
barring whatever the government says, or that look at this indicator, look at that indicator. I mean, we are down.
Okay, I got it.
Recession
Yeah,
in
yeah.
the US.
So you're basically, yeah, I think I've got it. You're basically taking lessons from the past and applying them to say that more or less, let's say 70-80%, it's more or less the same kind of thing, and we can apply those. That's fine. Okay, let's move on. I guess our next panelist is Shri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank. Siddharth?
Sure, sir. Thank you. So just to summarize the key views that we have for this particular policy and the next few ones, in this particular round, we do expect a slightly lower clip size of hike, somewhere in the range of 35 to 40 basis point hike in this particular round. And our view of the terminal rate is slightly on the softer side. We do expect the baseline scenario is around 575, but with a downward bias. So if I need to assign a probability between 550 and 6%, I'll possibly assign a slightly higher probability for 550 rather than for 6%, even though 575 is our baseline scenario. One particular very interesting thing that we have witnessed of late, that in the context of US also, that during the months of towards the end of June, early part of July, when the US's expectation about their July policy was actually firming up from about 75 basis point in July. There was a time when the market started thinking about 100 basis point hike in July, before again coming back to 75, which turned out to be reality. Now, even during that particular period, there was one very interesting observation on the US swap markets, that the swap rates didn't really move much. So basically what it was saying, that even though US inflation is very high, US is very clearly front loading their hikes, they might go as high as 100 basis point in the July policy itself. Even that point of time, just a few weeks earlier, market was much more convinced about eventually the terminal rate for US not changing so much just because US is front loading the hike. Now, very clearly, as all the other speakers have mentioned, that we are in a high inflation regime, even though growth is faltering and US has never been able to tackle inflation historically without getting into a recession, and they might end up doing it there itself. I mean, this time also, we do think that at some point of time, market will start focusing on at where the US hike ends, and whether there is possibility of a reversal of course on the part of US as early as in 2023. So essentially, we are talking about or witnessing a cycle which is far sharper than most of the other cycles, but can potentially be far shorter than most of the other cycles. This particular observation is possibly even more correct in the Indian context, where one cannot really think of or remember any particular hiking cycle when assuming that this time they hike by 35-40 basis point, that means 125 basis point plus they will be delivering in a span of just 3 months. It's very unusual on the part of RBI, and the hikes may not be over just now. But having said that, we do think that at some point of time now there will be a little more focus on where to stop, and that may be a little closer to what we had been thinking 2 months back and around June, or what the market consensus now at this moment. One particular point in the Indian context is also one would have to take into account the new EBLR regime external benchmark linked rates regime. Now, overall for the banking system as a whole, more than 40% of the asset books are now on an EBLR regime, which is leading to a situation where any rate hike by the RBI is getting transmitted entirely and instantly. I think that will also play some kind of a role going ahead at certain point in time. Very clearly, RBI may not be too unhappy the liquidity, the way liquidity is surplus liquidity balance is coming down. They might get to see eventually the effective rate from repo rate, reverse repo rate moving to repo rate, and they might be happy accepting that. So that effectively would also mean a little more tweaking in the within the corridor itself, moving on to the higher end of the spectrum. So overall, our bias is to think that even though the front loading remains very aggressive, continues to be very aggressive even now, irrespective of even if I expect a slightly smaller clip size, even if it is a 35 basis points, which is lower than some of the or most of the other panelists. This would, nonetheless, this is very aggressive front loading of RBI hike, but we do expect the terminal rate expectation over the course of the next few months to soften down a bit over the course of the maybe by the time it's next two policies.
Okay, thank you. Oh, you concluded. Dr. Charan Singh?
Arjun from Sundaram is going to be speaking. So would you mind, Mr. Chairman, if we give Arjun a chance before I speak?
Yeah, please go ahead. I have a little more time. I thought I'd have to leave at four, but I have a little time.
Sure.
Yeah.
We especially requested Arjun Nagarajan to be with us. So, and then I'll come at the end.
Okay. Go ahead. Mr. Nagaraj?
Can you hear me?
Yeah.
Yes, we can.
Yes, yeah. So I'll just be fairly brief. So where we are today, things are very fluid. Globally, the only issue at this point in time appears to be energy and food. Metals clearly are on their way down. There isn't any risk of China at this point in time. There's no expectation of any China-related surge on the fiscal front. So metals are off. Energy remains a little sticky. OPEC is on the 3rd of this month. So I think it looks very likely that OPEC narratives might be more of increased supply rather than any incremental cuts. So at least in the near term, energy, apart from natural gas, there isn't much of a risk. Food remains a point of concern globally, given the heat wave we are actually seeing in many parts of the world, especially in Europe. India food is related a bit to the spatial distribution of the monsoon that has not been that great. It has been pretty decent, but has not been very even across. So August and September will be important because vegetables respond fairly sharply to this. So this is, I think, how globally how I look at it. But from a policy point of view, I think there are only two things that actually stand out. One is, I think, the differentiation that Dr. Vidmani very clearly sort of brought out what the MPC is going to do and what the RBI is going to do. From an MPC point of view, I think on the rates front, 50 basis points is, I think, almost priced in from a market's point of view. If they do a 50, then I think their stance, and I'm saying stance, I mean the narrative, the language might be neutral. If they do less than 50, I think their language might be a bit more hawkish. I think this is how I sort of see it. And where I'm coming from is from a Federal Reserve point of view, from the last policy, not the policy of last month, the policy, the last to last month, the minutes were very clear, where the minutes were talking about a December pause from the Federal Reserve's point of view. And since this policy, the last policy and the data after this minutes, all of them have been fairly weakish, sort of reiterating the fact that there could be a December pause. So I think the RBI's policy is on the same day that the non-farm payrolls in the US are coming out. So the RBI policy is on Friday morning and the non-farm payrolls in the US are at Friday night. So if the non-farm payroll numbers are much stronger than what the markets are expecting, then the market narrative could shift to a 100 basis points or a strong, unusual rate hike in the September policy that the Fed spoke about last week. So in that situation, if that does play out, then this 50 basis points rate hike that I'm expecting for this policy and nothing for the rest of the year, that might get tweaked. So my terminal rate at 545 might go up a little bit to probably around 575, 580 or so. But if the non-farm payroll numbers on Friday are not any significant increase from consensus, then I think the current narrative of the Fed easing on its rate hike trajectory, I think that might sort of start playing in. So that's broadly where I look at it. On the liquidity front, if I look at where the net reverse repo was on March 30th, it was roughly at around 6.2 lakh crores. It's currently at around 10% that number, it's around 63,000 crores. I'm not quite sure if that is a very comfortable number at this point in time. So I wouldn't be surprised if the RBI comes up with something like an OMO, where it might be related to, again, what their currency interventions are. Because on the currency front, we have seen some weakness, but the trade balance number, the trade deficit number that we're running at close to 25 is not a sustainable number, clearly not a sustainable number. And the coal and the energy components of that are not likely to really come off in any significant way. So the trade deficit number is likely to see more pressure in the coming months. And if that does play out, I think the RBI will use the opportunity to support the currency even more. And at that point in time, to see to it that the domestic liquidity does not really dry up further than what it already has, I think they will have to bring out OMOs of sorts. And it might not be a policy announcement, it might be outside the policy, but I think that is also a very likely possibility that can come through. Yeah, I think I'll stop it there. Thank you.
Okay, thank you. Yeah, so I guess so far we've got kind of one very hawkish, two slightly hawkish, and one slightly on the less hawkish side, let's put it that way. So over to you, Charan.
Yeah, I'm going to be following the Sanyal model. My reasons are as follows. Firstly, I feel as far as inflation is concerned, again, the pressure is coming on vegetables and fruits and potatoes. And therefore, I think the energy story has almost played out. And Dr. Virmani, I totally agree with you, the way you explained the whole thing about the 70 to 100. Also, the feeling is that there is now moderation in oil prices as well as gold. My worry is somewhere else. My worry is on the exchange rate. The US certainly has appreciated, and exports, it could be impacting our exports and could get strengthened further, US dollar. So this could be disrupted. The IMF in its growth story just narrated a week back, they have scaled down India's growth rate by 0.8 basis, so to 7.4 now and 6.1 next year. Exports could be one component there, and that is where I agree with what Arjun Nagarajan just mentioned. As far as the differential is concerned, my own thoughts are the money which had to fly out substantially must have flown out by now, and therefore trying to maintain that differential may not be very essential. So keeping these factors in mind, what impact will it have on the banking sector is the angle that I was looking at. And the Reserve Bank in their financial stability report of June did bring out the story of the rising NPAs, the gross NPAs, and they had just at that point of time not visualized that this is how it'll all play out. And of course, US would be so aggressive. So if you look at the medium stress, and I would put it in the severe stress, the NPAs of the banking sector could increase. And this could increase both for the public sector and the private sector banks. So therefore, my view is that a substantial hike is not warranted. A 50 basis point would be too high, especially when Americans themselves have started rethinking whether they have gone too aggressive And therefore, I would agree with Arjun, we'll probably be waiting for the figures which get released at the end of this week. My suggestion would be, keeping in mind the growth story of India, the impact on exports that are expected, and no need to now maintain that differential. 25 basis point would give the signal there is alertness, and that should be sufficient as far as the Reserve Bank's this policy is concerned. In case America resumes its aggressiveness, then in the next policy, RBI could match it. They've already demonstrated by once calling off-cycle meeting. If worst scenario worst, they could do it. But in this meeting, keeping in mind the impulses which I'm mentioning, I think 25 basis points should be sufficient. Thank you.
Thank you. I think that is our entire panel. I think we'll conclude that there, Charan, and hand it over to Shri Mukherjee. Is he going to?
No, today I'll be concluding the session.
Okay.
So if we have, do you want to take a question or two, Mr. Chairman, or should we conclude?
Did anything come?
Yes, there were a couple of questions, but we had told 4 o'clock, it's 4:05. But if you allow one or two questions.
I would prefer that if you just read it out, then if
Okay, I can read it out.
I don't want to spend time on the. If
Sure.
there are few questions you can read out, we can see.
Sure. Give me a minute.
So one is liquidity interest rate by the US Fed that has kind of been addressed. Holding in HTM bond yields. This whole issue of supply constraint, they've all been indirectly addressed. I don't know if there's any specific question you can pick out.
Yeah, this is one with he's a banker, Mr. Narendra, former CMD. So he says we are yet to reach the pre-COVID level of 5.15% in repo rate. Hence, it's estimated that RBI had to first reach this level in repo rate, which is expected to be in the forthcoming MPC, other than further repo rate to tame the inflation to the comfortable level. What are the views of the panel? Would you like to yourself speak on this, or?
Well, I mean, if you just take the numbers, it's 20 basis points, right? And you are recommending or expecting 25. So that would answer that question, right? If it's 20 to 25 basis points, means you're just getting back to pre-COVID levels. If it's beyond that, all these other things we have discussed come into the picture. How much you can influence the inflationary expectations, the signaling effect, which is basically what you're doing when you're talking about inflation expectations. So we saw that one of our panelists was very aggressive. Two of them were thought that the way the trajectory. So it clearly depends on one's estimate of the inflation trajectory across the world and in India. And there are different views. I think MPC will have to take a view on it and act accordingly. There's nothing, I mean, one can take a vote. In a way, we've already voted, right, through our panelists. So there's really not much one can say on that, unless you have a particular view of the inflation trajectory.
So then, if I have the permission to conclude, given the time constraint that we have, I would say this has been an excellent discussion today. The panelists across the spectrum have expressed their views. Everything that one can imagine has got covered in our discussion today. We have discussed about the prices, the growth story, the American scene, the exchange rate, the utilization of foreign exchange reserves, and of course the banking sector. The spectrum, as the chairman mentioned, of the views has also been very varied. And now I think the MPC will probably be taking a call, and we'll be probably waiting to see what happens on Friday. The truth is, we'll not only be waiting for Friday morning when RBI announces, but we'll all be also eagerly waiting for Friday evening what the Fed and what the American data comes out to be. So very uncertain times, both for policymakers as well as central bankers. With this, I would conclude the session today. I would thank each one of you to have made this discussion very interesting. I would like to thank all the panelists, starting with Dr. Virmani, and I would also like to thank Mr. Agarwal for welcoming the panel and ASSOCHAM for partnering with us in this shadow monetary policy. Thank you very much.
Thank you so much, sir.
Thank you.